So, what exactly does it mean when they say an insurance company canceled a bunch of insurance policies in a certain area? It may be because of natural disasters, fires, floods, hurricanes, earthquakes, whatever the case might be. You see a lot in the news where they say such and such insurance company has canceled thousands of policies right before a disaster. Well, in reality, insurance companies don't actually cancel policies. A policy, while it's in effect, really can't be canceled by the insurance company except for two most important reasons. If the person with the insurance doesn't pay their premium, meaning that if you pay your premium every month and you stop paying, they're going to cancel your insurance. If you committed fraud on your application, they'll cancel your insurance. But what they mean when they say canceled your insurance, it means they non-renewed your insurance. There's a big difference. Insurance is a policy that has a time period of coverage. Usually you buy a 1-year insurance policy, and every year you renew your insurance, kind of like renewing your driver's license. So at the renewal date or expiration date, your insurance agent who sells you the insurance, usually a month or two in advance, will say, hey, look, your homeowner's policy, your car policy is up for renewal, and you can review your coverages, make sure you have the right type of policy, you pay your premium. Now, insurance premiums technically are an annual premium. So if your insurance is, let's say, $1,100 a year, you could pay that $1,100, or some people finance it and they just pay, $90 a month each month for a year. But in reality, it's an annual policy. So when you hear that an insurance company canceled insurance, what they mean is they non-renewed insurance, which means that the people in a certain area, a certain neighborhood, a certain zip code, a certain state, do not get to renew their insurance with that company because the company's decided, we don't want to sell insurance in this area. And you might think, well, gee, that's terrible of them, and they're shutting these people out. Well, think about it. If the company was making a big profit, or it was viable for them to sell insurance, of course they would sell it, right? People want to sell stuff. Companies want to sell things. The reason that they decide we're not going to sell it is because they're going to lose money. And the reason sometimes they lose money is because the government in that state has put a cap on how much they can charge. If you're an insurance company and you want to sell insurance in a state for homeowners, auto, whatever the case might be, every year you have to go to that state and tell the insurance commissioner how much you're going to charge for insurance. And they have to approve your rates. That's the one thing about insurance rates. They have to be approved by the insurance commission in that state, in every state you do business. In addition, the terms and conditions of your policy are also reviewed by that commissioner to say, yeah, this is good insurance. So if you have a policy that says, I'm going to cover your house if it burns down, and we're going to charge X amount of dollars per year for the house, the insurance commissioner looks at it and says, no, that's too much money. Or no, your policy is not good enough. You can't sell that policy. So you have a choice. You can either not sell the insurance, or you can change it to match what the insurance commissioner wants. And you might say, why don't they just lower the price? Well, that creates another problem. If you lower the price of insurance where you're not collecting enough money to be able to pay out claims, first of all, it's going to create a problem for your company. But even if you were an insurance company that decided, you know what, we're going to be nice to people. We're going to lose money on insurance because we care about homeowners. We care about property owners. And we're not going to charge them that much, even though we're going to pay out more. Well, the insurance commissioner will step in again and say, this is not good. Because as an insurance company, you have to show to the insurance commission that you are collecting enough money and you have enough money in the bank to be able to pay out claims when they come in. So if you decided just because you're an altruistic or caring company that you're not going to charge as much money for policies as it takes to pay out claims, the insurance company will shut you down. The insurance commissioner will shut you down. The insurance licensing board will shut you down. So you have to submit to that licensing board your premiums you're going to collect from, let's say, that whole neighborhood. Let's say everybody in the neighborhood pays $1,000 a month, and that's an unreasonable number, but we'll use it as a round number. And you have 100 policies in that neighborhood. So you're collecting $100,000 a month. That's about $1.2 million a year. But if your claims history shows you're paying out $2 million a year on claims in that neighborhood, you're not going to have enough money to pay claims. The insurance commissioner is going to say, you won't be able to last in business, so we're going to shut you down. Or even if you pay out only 1.2 million in claims, the insurance commissioner is going to say, well, where's your money for your payroll, for your rent, for all of your expenses, your insurance? And they're going to make sure that you have enough income to cover the expense of paying out claims. And the insurance company has to walk a fine line. They can't charge too much because then people won't buy insurance and the insurance commissioner won't accept it. But if you charge too little, you won't be able to pay out claims even if you wanted to, because you'll have no money in the bank. And the insurance commissioner will look at your balance sheet and your profit and loss statement and say, this is not the math doesn't work. This insurance business strategy, this business plan is not going to be sustainable. So even though it might seem like insurance companies charge too much, they gauge and they calculate their premiums based on what they estimate the payouts are going to be. And that's sometimes based on the past, but also based on what they think is going to change in the future. Certainly they're going to make a profit. That's the reason that they do this, because all their employees have to get paid. They have stockholders. The question is, how much is too much profit? Insurance companies are usually on par with other types of companies. The other thing is, if they weren't making an average amount of profit that companies do, they would also get out of the business, because the capital and the cash involved to go into a business, to fund everything, to finance everything, to buy buildings, to pay for payroll, if you weren't making a good return on that, you would just put it in the bank, put it in a CD at 6%, or invest in real estate at 8%. So unless you're making a higher return, what's the reason for putting it into an insurance company when you could get wiped out in a year if there's a big fire or an earthquake or a flood or a hurricane? So insurance companies have risk, and the investors and the owners of the insurance company have to calculate, is it worth putting my money into this company when I can't charge enough money to pay out claims? You will be back in your video in just a few seconds. In the meantime, remember that actualhuman.com offers you live one-on-one private video consultation with an expert in this exact subject. We want to listen to your story. We want to hear your questions. We want to give you expert advisement of your options and tell you what we know about your particular situation. Now back to your video. I can't charge enough money to be profitable. And again, it's a fine line. The question comes is when the insurance companies take advantage of that, and when they are not being responsive to claims. For most P&C, property and casualty insurance, which is auto, homeowners, physical damage, those kind of things, the rates and the coverages are very, very well managed and regulated by the insurance commission in that state. So they usually don't get too far out of whack. If anything, sometimes they charge too little. It's easier for a company to undercharge for insurance than it is to overcharge, because they could say, well, we won't pay out that many claims. We don't need to charge that much money. And sometimes a new insurance company trying to break into a market will undercharge for premiums to try to get market share, steal customers from other companies. That's why you see Geico, 15 minutes to save you 15% on car insurance, right? You don't see that as much anymore, because when they first did that marketing campaign, they were trying to be a new player to gain market share. Now that they have the market share, they've ramped up their rates more in line with the rest of the companies. Other types of insurance, not so much. Health insurance, there's not as much regulation, and it's easier to overinflate. But property and casualty, even though it's easy punching bag to kick when they're down, when there's a big event, fire, hurricane, flood, earthquake, Again, those executives and those actuarials try to calculate very, very carefully how much they can charge and not try to charge too much, because if they charge too much, they'll lose business to another company. Remember, there's competition with insurance. So if you see a big company pulling out of a market or non-renewing policies, it's not because they're trying to be a jerk. It's because they looked at that market and said, I probably can't pay out claims if I only charge this much in the long run. And if I charge a lower amount, or the amount that the insurance commissioner doesn't let me go above, I might be out of business if I have a big event, an earthquake or fire. So again, insurance companies, they're not charities. They're not doing this for free. They are making money, but in many cases, the profit that they make is in line with every other company you do business with. You buy a pair of Nike shoes, they probably make more profit on the Nike shoes than on your insurance policy. And certainly it's more sensitive because the insurance company is there to look out for you when they have to pay a claim. You're depending upon them to fix your house or buy you a new house or to repair your car. So it's a little bit more sensitive and a little bit more emotional when that happens. And again, I'm not saying the insurance companies are making money, their executives are multimillionaires. That's not the issue. It's that the first of all, the word cancellation really isn't accurate, because they really don't cancel policies. They non-renew it, which for many consumers seems like a cancellation. You have your policy every year, you pay your premium, and all of a sudden they tell you, we're not going to renew your policy. Nowhere does the word cancellation appear in those notices. It always says non-renew. Cancellation would happen is if in the middle of your 1-year policy, they say, we're canceling, we're pulling your policy. They can't do that. It's a contract. They can only do it if you don't pay the bill, or if you committed fraud on your application, you lied to them some way. Now, most people don't realize their policy is annual because they just pay a monthly premium. They basically finance their insurance. So they don't really know that there's a renewal every year. They just think, oh, I just got this notice, I can't have insurance anymore. That must mean it got canceled. That's not what happened. What happened was, at the end of that policy term, that 1-year term, the insurance company said, we've looked at this, and this rate we're charging you and the risk we have and the amount we have to pay, it doesn't make sense. We're not going to be able to pay out the claims. The insurance commissioner will look at our bank account and say, you don't have enough money to pay claims because you haven't collected enough from the consumers. So we're not going to be able to do this. And if you notice, the places where this is happening are in places where they're not allowed to increase rates. Good example is Florida and California, right? They both have big insurance problems. In California, people can't get coverage. In Florida, the rates are too high. In Florida, you can get insurance coverage. If you're in a hurricane zone, a flood zone, you can get insurance coverage. It's going to probably cost you a lot of money. There's some people paying $10,000, $15,000, $20,000 a year for insurance, but at least you can buy it. In California, the companies are pulling out. Why? Because California has put a cap. You can't charge more than this much money. And so the insurance company says, well, if I can't charge what it takes to pay the bills, then I have to stop. I have to. It's almost like saying, if you were, I'm trying to think of if you're a lemonade stand, right? If you had a lemonade stand on the corner of your house, and for every cup of lemonade, you spent 8 cents on sugar, lemons, the cup, the water, and the ice. 8 cents. That was your cost. And you sold your lemonade for 20 cents a cup. And all of a sudden the government came in and says, you can only charge 5 cents for a cup of lemonade. Max. You can't charge more than 5 cents. Okay. Well, maybe you could for a while, because if you wanted to be nice to the community and kick in the other 3 cents yourself, you could do that. But at some point you'd run out of money and you wouldn't be able to continue. And if the government also said, we're only letting you charge 5 cents, we're also going to look at your bank account to make sure that it's growing, you'd have to shut down the same day. So again, it's an oversimplification. I'm not trying to be an apologist for the insurance companies, because certainly they all have their faults. They all do things wrong. But we do need to have insurance. We do need to have a viable, sustainable, financially sound insurance market. We need to have companies that are willing to sell insurance, because the more companies that pull out, the ones that are left, they're taking more risk. It's not divided up over 10 companies, it's only divided up over 3. So now if you have a catastrophic event, one hurricane, one earthquake, one fire could wipe out the remaining 3 companies. If it was divided up over 10, yeah, they might struggle, but at least they could pay out the claims and stay in business. I'm certain that everybody has very strong opinions about this insurance reality. I'd love to hear in the comments below what you think. Again, don't shoot the messenger. We're just trying to describe, first of all, the reality that insurance being canceled is not really what's happening, because they're not just yanking the rug out from under you in the middle of your policy. Usually you have 2 or 3 months notice before your policy is due to find another one if they're not going to renew it. And at the same time, the insurance rates, yeah, they're high and they've gone up, but they're also calculated by the insurance company figuring what is the minimum we can charge and still be able to pay claims. And the minimum is because companies want market share. They want to sell as many policies as they can. They want to grow their business. So by having lower prices, they'll grow their business, especially when there's competition. If they jack up the rates too much and there's other people that are willing to sell it for $1 less, they'll lose market share. So in most cases, the economy works. In some cases, it gets a little bit crazy, but at least there is a huge amount of regulation at the state level for what they can charge by your insurance commissioner and the board that looks at rates and coverages. Thank you for watching another video at actualhuman.com and describe.tv. Remember, if you have questions or comments about our videos, put them in the link below. Also, remember that you have availability and access to live one-on-one question and answer consultation with a licensed expert in a number of fields: investigations, insurance, surety bonds, civil court mediation, even things like real estate records research, real estate brokers, real estate mortgage lenders. In addition, you're going to find that experts are available in business segments, business development, marketing, advertising, certified licensed experts. So if you do find this content valuable and you want to delve more deeply into a subject, you can't ask YouTube a question, right? But if you want to talk to somebody live, an actual human, use the link below. Thanks for watching.